The Commitments of Traders, or COT Report, is a valuable tool. It's like a window into the minds of major players in the market. This report, published by the Commodity Futures Trading Commission, provides a breakdown of the holdings of different types of traders in the futures market. Think of it as a snapshot of who's betting on what. This information can be extremely useful for traders and investors. It helps them understand market sentiment and potential price movements. By analyzing the positions of different trader groups, you can get a sense of whether they are bullish or bearish on a particular asset. This report is particularly helpful for commodities like gold, oil, and currencies. It can also be used for analyzing stock index futures. The COT report doesn't tell you exactly what will happen in the market. However, it's a powerful tool that can give you an edge in your trading. COT report is published every Friday at 3:30 p.m. Eastern Time. It covers positions held as of the previous Tuesday. The report is divided into several sections. It includes data for various asset classes, such as agricultural products, metals, energy, and currencies. Each section breaks down the open interest in futures contracts held by different types of traders. The report presents this information in a tabular format. It shows the number of long and short contracts held by each group. The COT report also provides historical data. This allows you to track changes in positioning over time. You can access the COT report for free on the CFTC website. Various financial websites and platforms also provide this data. The COT report classifies traders into three main categories: commercial traders, non-commercial traders, and non-reportable positions. Each group has unique characteristics and motivations. Commercial traders are companies or institutions that use futures contracts for hedging purposes. These are the smart money players. For instance, an airline might use oil futures to protect itself against rising fuel costs. Non-commercial traders are typically large speculators, such as hedge funds and institutions, who trade for profit. They bet on price movements. They are often trend followers. Non-reportable positions represent small traders who do not meet the reporting thresholds of the other two categories. The COT report is a valuable tool for understanding market sentiment. By analyzing the positions of different trader groups, you can get insights into potential price movements. For example, if commercial traders are heavily net long in a particular asset, it suggests they are bullish on its price. Conversely, if non-commercial traders are heavily net short, it could indicate a bearish sentiment. Traders often look for extremes in positioning. This can signal a potential market turning point. For instance, if non-commercial traders are holding a record number of long contracts, it might indicate an overbought market. However, it's crucial to remember that the COT report is not a foolproof indicator. Market sentiment can change quickly, and other factors can influence price movements. Section 5, the bigger picture COT in context. The COT report is a powerful tool. However, it's essential to use it in conjunction with other forms of market analysis. Technical analysis, fundamental analysis, and economic indicators can provide a more comprehensive view of the market. One limitation of the COT report is that it's a lagging indicator. It reflects positions held as of the previous Tuesday. This means that market sentiment may have already shifted by the time the report is released. Additionally, the report doesn't provide insights into trader motivations. For example, a large short position by commercial traders could be a hedge or a speculative bet. Despite these limitations, the COT report is a valuable tool. It's like having a secret weapon in your trading arsenal. By understanding how to interpret its data, you can gain a deeper understanding of market dynamics and make more informed trading decisions.